Hi everyone, this is Mia. If you own a small business, drive a work vehicle, or even run an Airbnb, you will want to hear this one because in 2025, the big beautiful tax bill make a major change to Section 179 that let you write off up to $2.5 million of business purchase in 1 year. Let's go line by line so you know exactly what changed, who qualifies, and how to make it smartly without stripping into an IRS mistake later. What is Section 179 is and what it isn't. Section 179 is the part of the tax code that lets business owners expend equipment or property in the year they buy it instead of spreading the deduction over several years. So instead of slowly deducting $10K a year or $50K for a $50K truck, you can deduct the full $50K right now, as long as it's used mainly for business. Think of it as a fast-track deduction if you get your tax saving now, not later. But here what is not a free-for-all. So you can't claim Section 179 for personal stuff or for passive investments. It's strictly for active businesses. And this year, the limits just jumped higher than ever before. So what's changed under the big, beautiful tax bill? Starting in 2025, the new law raised the Section 179 limit to $2.5 million per year. That means small businesses can write off up to $2.5 million of qualifying assets, things like vehicles, machineries, computers, tools, or office furniture. But there's a ceiling because your total equipment purchases for the year passes $4 million. The deduction starts phasing out dollar for dollar. So this rule is meant for small and mid-sized businesses, not for massive corporations. Here's another big win. The new law also expanded what qualifies. Now you can expand things like HVAC systems, air filtration systems, security systems, roof improvements, and even certain furniture for lodging or rental properties. Before 2025, these aren't eligible. Now many are. If this already sounds helpful, go ahead and tap the like button. It helps other small business owners find the information, and it tells me you want more breakdown like this. Who qualifies and who doesn't? Let's get real about this part, because not everyone can use Section 179. Who can use it? The self-employed people filing Schedule C, like consultants, real estate agents, or freelancers. LLCs, partnerships, and S corporations with taxable income. Farmers and contractors buying tools or equipment or machinery. Airbnb or short-term rental owners if they actively manage the property as a business, not passive renting. Who cannot use it? The W-2 employees who buying tools for their job, passive investors like someone who just collect rent but doesn't manage it, anyone trying to use a deduction to create a loss. It doesn't work that way. Or purchases used mainly for personal reasons. The last thing that trip people up usually, if you buy a truck for your business but drive it mostly for personal errands, you can't expense the full cost. You would have to prorate it based on the actual business use. Now, how can you use it the right way? Here's how the Section 179 really works step by step. First, you buy the item, but it must be new to you, or used equipment count, but not personal properties you already own. Second, you place it in service before December 31st, meaning it's installed and ready to use for your business. Third, You report the deduction on Form 4562 when you file your tax return. 4. If your business doesn't have enough income to use the full deduction, the unused part carry forward to the next year. That's it. Here's the golden rule. You must have business income to take the deduction. Section 179 can't create a loss. If you are new here, by the way, this is part of my Big Beautiful Tax Bill series, breaking down every major change for small business owners. You can subscribe anytime to stay caught up. Let's make it real with some examples. Let's say you are a landscaper. You buy $150,000 worth of new mowers and equipment in 2025. You can now deduct the entire $150K this year, saving around $33,000 in taxes if you are in the 22% bracket. Or maybe you are a freelancer photographer who spent $10K on cameras, lighting, and computers. So same deal, you can write it all up in 2025 instead of depreciating it over years. If you are a landlord who runs a short-term rental and just replace your HVAC and added furniture, you might be eligible too if your rental qualifies as a business. But that is a big if, because the IRS look at things like whether you clean between guests, handle bookings, and manages regularly. If you just rent long-term and collect checks, that's passive. So no Section 179 for that. You want to combine it with bonus depreciation. That is another big strategy that people use. Now here's where the 2025 law get even better. Under the Big Beautiful Tax Bill, bonus depreciation is back at 100% permanently. So after you use Section 179 for what you can, anything left over can still be deducted in full under bonus depreciation. So Section 179 applies first, and then bonus depreciation picks up the rest. But one key thing different here, Section 179 can only go up to your business income, while bonus depreciation can create a loss that carries forward. Smart tax planning is figuring out how to use them both together. So that's why most CPAs model both before filing. If you want a tool to run those numbers yourself, I have built a simple business assets write-up planner and show how much tax saving you get using Section 179 and bonus depreciation side by side. You can find it at Pro Deductions on Etsy, the links below. Here are some tax planning tips that you should not skip. So let's cover the tips that break this strategy. So tip number 1, make sure the asset is placed in service. So ordering it isn't enough. It has to be usable by year end. Tip number 2, don't over-deduct yourself into a corner. So Section 179 reduces taxable income, which can reduce your qualified business income QBI deduction under Section 1998. So if you rely on that 20% QBI deduction, your tax pro should help you balancing both together. Now tip number 3, keep your receipts and asset list organized. You want to date it, put the cost, put the serial number, and when you started using it, the IRS check that stuff. Tip number 4, vehicle rules are tricky. Passenger cars are capped around $28,900 for 2025. So that heavy vehicle over 6,000 pounds often qualify for full expenses. Make sure the vehicle really is a business vehicle, not your family SUV. Tip number 5, check your state conformity. So states like California, New Jersey, and Hawaii don't match federal rules. So you might owe state tax even if you get a federal deduction. If you have learned something new so far, leave me a quick comment below. I always reply with a practical tip for your situation when I can. Here are some common mistakes to avoid. First is personal use. So if business you drop below 50% later, you might have to recapture the deduction. Another tip is about incorrect timing. So purchase doesn't mean ready. It has to be in use before December 31st. Another tip, not filing Form 4562 or forget to attach it, so you might lose the deduction. Here are some simple mistakes that cost people real money, so double check them as filing. So here is the bottom line. Section 179 let you deduct up to 2.5 million of qualifying business property in 2025. The phase out starts at 4 million, and the change is permanent and indexed for inflation. It's one of the most powerful small business tools in the new big beautiful tax bill, but only if you use it the right way. If you want to go deeper, I got free resources and checklists at accesswideinstitute.com and the write-up planner at Pro Deductions on Etsy to help you model your 2025 strategy. Don't wait until March. Start planning now while you can still time your purchases. And as always, like, subscribe, and share this with another business owner who deserves a smarter tax season. I will see you in the next big beautiful tax bill update. Bye.